We issued a clear warning. We informed you that once financial institutions began to lose their grip on asset pricing, they would not idly permit market forces to dictate terms. We anticipated that if short sellers faced imminent collapse, the established financial architecture itself would intervene to provide a lifeline. We foretold that if they were unable to secure victory within the existing framework, they would inevitably rewrite the rules of engagement. Today, Tuesday, January 13th, 2026, they indeed altered the rules. While your attention was fixated on silver's ascent towards $86 per ounce, the Chicago Mercantile Exchange, known as the CME Group, disseminated an urgent advisory notification. This notice bore the designation 26-019. To the ordinary investor, this document would appear as nothing more than a dry PDF. However, to those with inside knowledge, it represented a decisive act of aggression against the price of silver. Effective immediately, the CME is modifying its methodology for calculating margin requirements pertaining to precious metals. The transition is from a fixed monetary sum to a percentage of the notional value. Specifically, they have instituted a 9% margin requirement for silver. To articulate this in straightforward terms, with silver trading in the vicinity of $85 per ounce, this adjustment effectively elevates the expense of maintaining a silver contract position by approximately 15%. This will escalate the margin from $32,500 per contract to over $38,250. This constitutes an immediate increment of nearly $6,000 per contract. The rationale for this action and its precise timing warrants examination. This measure was implemented because as of yesterday morning, silver experienced a parabolic surge, opening with a significant gap between $82 and $85 and reaching as high as $86 during the early electronic trading session. The commercial banks, who hold short positions amounting to millions of ounces of derivative silver, were confronting the precipice of insolvency. Their imperative was to halt the buying momentum and expel leverage from the market by increasing margin requirements. The exchange compels every participant who acquired silver using borrowed funds to make a critical decision: either deposit an additional $6,000 in cash immediately or face the liquidation of their holdings. This maneuver serves as a liquidity extraction mechanism intentionally designed to precipitate a wave of forced selling. It is the identical strategy that was employed to depress the silver market in 2011, and it was deployed again in the year 2020. For a fleeting duration this morning, it appeared that this tactic had proven effective. Observe the 30-minute chart we have been scrutinizing. Note the series of red candlesticks on the extreme right of the display. At precisely the moment the margin adjustment news was disseminated through trading terminals, the price of silver plummeted from $86 to a low of $83.57. This precipitous decline was not a consequence of natural selling pressure. Rather, it was the algorithmic response to the altered regulations, the audible signal of leveraged speculators being liquidated because they could not meet the new capital demands to remain in the game. The mainstream media will likely present this price drop as definitive proof that the rally has concluded, proclaiming that the upward momentum has been broken. They will encourage you to view those red candles with apprehension, aiming to persuade you to divest your holdings of physical silver solely because the paper price experienced a reduction of $2. However, before succumbing to panic, it is imperative to examine the chart more closely. Focus your attention on the subsequent price action following this engineered downturn. In 2011, following 5 instances of margin increases within a single week, the price of silver experienced a 30% contraction over a matter of days, falling from $50 to $35, a veritable massacre. Today, despite a 15% margin hike, a substantial punitive adjustment, the price only declined by $2.50. Furthermore, direct your gaze to the very last candlestick on the chart, observing the extended lower wick. The price dipped to $83.57, only to be immediately bought back. As we speak, silver is trading at $83.90. It has demonstrated an astonishing resilience, refusing to falter. This represents the most potent bullish indicator observed throughout this entire market cycle. The established powers unleashed their most formidable instrument. They deliberately increased the cost of acquiring silver, attempting to shatter the foundation of the bullish market. The sole outcome was a mere $2 decline, which is already being absorbed by demand. Why did this strategy not result in a collapse? What distinguishes this episode from past events? The reason lies in the identity of the buyers at the $83 level. They are not utilizing margin. They are not speculators gambling on chart patterns. These are industrial consumers, sovereign wealth funds, and direct cash purchasers. One cannot issue a margin call to a party that settles transactions in cash. If a company like Samsung requires silver for its battery production, the prevailing margin requirements set by the CME are of no consequence to them. They are not engaging in futures contracts for speculative purposes. They are purchasing the metal for physical delivery. Should the price recede to $83, they will simply procure more, viewing it as an advantageous opportunity. The margin increase exclusively impacts participants holding long positions in derivative contracts. It has no bearing on those holding physical silver. In fact, it benefits them by enabling them to acquire cheaper metal from less committed holders who have been compelled to exit their positions. This development substantiates our hypothesis of market bifurcation. The derivative market is subject to manipulation through regulatory adjustments and margin revisions, whereas the physical market is driven by genuine and unmitigated scarcity. The financial institutions are akin to attempting to extinguish a forest fire with a squirt gun. They might momentarily dampen the flames, but the underlying heat is far too intense. However, the margin adjustment is not the sole indicator of systemic desperation witnessed today. Concurrent with the exchange's rule alteration, the United States government engaged in seeking external assistance. Reports indicate that Treasury Secretary Scott Bessent convened an emergency assembly of G7 finance ministers this morning. The official agenda item was the safeguarding of supply chains. When a Treasury Secretary convenes a meeting concerning supply chains amidst a price surge, it is a veiled communication. It signifies depletion. It implies that strategic reserves have been exhausted. If the margin hike constituted the financial response to the silver crisis, then the intelligence received this morning from Washington, D.C. represents the political response. And for those adept at interpreting diplomatic communiques, the political ramifications are considerably more alarming than the financial ones. While the CME was occupied with modifying the rules of the financial casino to support the banks, the United States Treasury was engaged in efforts to stabilize the economy itself. We have received confirmed intelligence that Treasury Secretary Scott Bessent convened an urgent, unscheduled meeting with the finance ministers of the G7 nations this morning. The Group of Seven, often referred to as the Economic NATO, constitutes the most formidable financial bloc in the Western world. Their deliberations were not centered on climate change or tax policies. According to the official pronouncements, their focus was on identifying solutions to secure and diversify supply chains for essential minerals. To the uninitiated, this terminology may appear as mundane bureaucratic jargon, indicative of standard governmental procedures. However, it is crucial to consider the temporal context and the underlying circumstances. Why was this meeting scheduled for today, Tuesday, January 13th? It was convened due to silver reaching $86 yesterday, the Shanghai premium escalating to $8, and the global inventory of the Earth's most efficient electrical conductor effectively reaching zero over the preceding weekend. When a government articulates a need to secure supply chains, it is code. It is a diplomatically phrased admission of scarcity, signifying a disruption in the flow of materials. And when they advocate for diversification, it implies an over-reliance on geopolitical adversaries. Reflect upon the origins of silver supply. China ranks as the third largest producer and the preeminent refiner. Russia is a significant producer. The BRICS nations collectively control a substantial proportion of global supply. The G7 finance ministers assessed the market landscape this morning. They observed the Shanghai market absorbing metal from London and New York, and the surge in retail demand depleting the reserves of the United States Mint. This led them to the realization that the West is inadequately prepared. The United States government divested its strategic silver reserves decades ago, leaving it with no strategic stockpiles. Its reliance is entirely placed upon the just-in-time global market. However, as previously discussed, the era of just-in-time logistics has concluded. We have entered an epoch defined by a precautionary approach, and the United States government has just recognized its deficiency in this regard. This meeting directly correlates with the events of January 3rd in Venezuela. Recall Operation Absolute Resolve. The media portrayed it as an endeavor to promote democracy, whereas we identified it as an operation centered on oil, indicative of Stage 4 imperialistic behavior, driven by a desperate pursuit of resources. Now, 10 days later, we witness a comparable level of alarm permeating the metals market. The dominant powers are recognizing their inability to sustain kinetic warfare, construct a green energy infrastructure, and maintain a digital economy without substantial quantities of silver. Modern conflict is predicated on electronic systems. Every Tomahawk missile, every F-35 fighter jet, every unmanned aerial vehicle, and every satellite necessitates silver. It is unparalleled in its conductivity of electricity within the known universe. The fabrication of guidance microchips is impossible without it. If the supply chain experiences a rupture, which indications of dealer delays suggest may already have occurred, the military-industrial complex will face an immediate cessation of operations. This explains Secretary Bessant's involvement. This transcends mere commodity pricing and has evolved into a matter of national security. The system's response is a coordinated effort. The CME increases margin requirements to suppress the paper price and divest speculators. This action buys the government valuable time. Subsequently, the Treasury convenes the G7 to formulate a strategy for acquiring physical metal through off-market channels. Their objective is to establish a purchasing consortium. They aim to collaborate with European nations, Japan, and Canada to secure mining concessions in allied territories such as Mexico and Peru before China consolidates its dominance. However, a significant challenge exists. The Chinese have already established a strong presence. For years, the Chinese have been entering into offtake agreements while the West remained preoccupied with ESG metrics and derivative instruments. The G7 meeting signifies a vulnerability, not a position of strength. Had they possessed the requisite metal, such a meeting would be unnecessary. If the market were functioning optimally, there would be no need to engage in securing supply. The fact that this meeting occurred today, directly in response to the price surge, corroborates our ongoing analysis. It unequivocally demonstrates that the $86 price point is not indicative of a speculative bubble, but rather a signal of a profound systemic deficit that has reached the highest echelons of government. Furthermore, note the semantic shift. Essential minerals. For decades, silver was characterized as merely a precious metal, a decorative item, a relic of a bygone era. Now it is suddenly designated as a critical mineral. This reclassification is deliberate. By categorizing silver as essential, it opens the avenue for governmental intervention. It empowers the administration to invoke the Defense Production Act, thereby prioritizing industrial allocation over individual investment. This sets the stage for future measures such as rationing. If Samsung requires silver for its batteries and Raytheon requires silver for its missile systems, and you seek silver as a repository for your wealth, who do you believe the government will prioritize? Their priority will undoubtedly be the missile systems and the batteries. The G7 meeting represents the initial step towards a bifurcated market structure, effectively excluding the general public. They will endeavor to impede your acquisition of the metal, likely by increasing premiums and implementing purchase limitations, mirroring the recent occurrences with Costco. They will also propagate negative narratives regarding hoarders, as their objective is to secure the metal for their own strategic needs. Therefore, when you observe a $2 decline in the price of silver attributed to a margin adjustment, resist discouragement. Instead, cultivate a sense of urgency and take proactive measures. The very entities responsible for artificially suppressing the price on trading charts are the same ones conducting emergency deliberations to secure the metal you possess. The CME margin increase served as a diversionary tactic, while the G7 meeting reveals the underlying reality. They are cognizant of the bond market's instability, evidenced by the Indian bond sale. Now they recognize that the commodities market is also fracturing. They are engaged in a conflict on two fronts against the inexorable forces of economic gravity. Just as the margin increase failed to drive the price below $83.50, the G7 meeting will prove ineffective in generating new supply. One cannot magically conjure a silver mine, nor can legislative action create a new mineral deposit. The establishment of a new mine requires a decade of development. Secretary Besant can conduct as many meetings and issue as many official statements as he desires, but without a magical means to transmute lead into silver, his efforts will be futile. The systemic response is faltering. The financial instruments are proving inadequate, the political measures are protracted, and the market is exhibiting rapid momentum. In the subsequent segment of this in-depth analysis, we will examine the phenomenon of the Shanghai Shield, elucidating why the arbitrage differential with China acts as the ultimate bulwark against Western market manipulation. We will demonstrate why even a 50% margin increase by the CME would be rendered inconsequential as long as Shanghai maintains its pricing at $93. The West is attempting to seal the door, while the East has forcefully removed it from its hinges. The G7 is in a state of panic. The CME is in a state of panic. The critical question remains, are you experiencing panic or are you adequately prepared? We have meticulously analyzed the weaponization of exchange regulations by the CME and dissected the geopolitical anxieties manifested at the G7 level. Now we must address the most pivotal question of the day: why did these measures prove ineffective? In 2011, when the CME implemented margin increases, the price of silver experienced an immediate and significant collapse. In 2020, during the pandemic-induced market downturn, margin calls exacerbated the sell-off, driving silver prices down to $12. Historical precedent suggests that when an exchange raises the stakes in a financial game, participants tend to withdraw. However, today, Tuesday, January 13th, the participants did not withdraw. They persisted. The price of silver dipped to $83.57 and subsequently rebounded. It demonstrated an unwillingness to breach this level, standing firm and absorbing the impact with the resilience of a seasoned boxer shrugging off a powerful blow. What has fundamentally altered the market structure to enable silver to withstand a 15% margin increase? The answer lies approximately 7,000 miles away, and it is known as the Shanghai Shield. While the CME was actively attempting to suppress prices in New York, the Shanghai Gold Exchange concluded its afternoon trading session with silver fixed at $93.31. Performing the necessary calculation reveals a spread of nearly $10 between the paper price in the West and the physical price in the East. In prior market cycles, such a disparity did not exist. In 2011, prices in London, New York, and Shanghai were largely congruent, signifying a unified global market. When New York experienced a price decline, the rest of the world followed suit. However, the market has now fractured. The West is engaged in trading paper instruments while the East is trading physical metal. Consequently, because the East is willing to pay $93, the price in the West is fundamentally constrained from falling significantly below $83. This phenomenon can be explained by the physics of the Shanghai Shield. If the CME were to successfully drive the price down to $70, would this damage the bullish market? No, it would, in fact, accelerate it. If silver were to fall to $70 in New York, while Shanghai maintained a price of $93, the arbitrage profit would surge to $23 per ounce. This represents a risk-free return exceeding 30% simply for the transportation of a silver bar across the ocean. Every trader globally would capitalize on the COMEX price reduction and sell into the Shanghai demand, effectively depleting the COMEX vaults within 48 hours. This presents a strategic quandary for the banks. They are checkmated by the arbitrage mechanism. If they suppress the paper price, they risk losing their physical inventory to China at a discounted rate. Conversely, if they permit the price to ascend, they face the prospect of insolvency on their short positions. They are compelled to make a choice: preserve the physical metal or preserve the dollar. The inventory data received this afternoon confirms their predicament, indicating a depletion of metal while the price was being artificially suppressed on screen. In reality, the vaults were being raided. Examine the depository statistics released by the CME Group today. They present a stark picture of withdrawals. Over 565,000 ounces were withdrawn from Asahi, 617,000 ounces from Brinks, 351,000 ounces from CNT, and 791,000 ounces from StoneX. In total, more than 2.2 million ounces of silver were removed from the COMEX system within a single day. Critically, the registered category, representing silver available for immediate delivery, decreased by nearly 400,000 ounces, leaving only 123 million ounces. This represents a significant outflow. The margin increase did not stem this outflow. Instead, by driving the price down to $83.50, it inadvertently facilitated it. The CME has effectively placed silver on sale for the very entities that are draining its reserves, thereby feeding the demand. This situation directly links back to the G7 meeting. Secretary Bessent is aware that the COMEX is experiencing substantial outflows and that the metal is migrating from west to east. This explains their discussions regarding supply chain security, an attempt to erect a barrier. However, it is impossible to contain a market with a $10 price differential. Capital is mobile and flows to where it is most favorably treated, which at present is Shanghai. The Shanghai Shield is the fundamental reason why one should not be apprehensive of market volatility. When observing a price decline, recognize that it is encountering a floor of solid concrete, the Chinese bid. Unless the price in Shanghai experiences a comparable collapse for which there is no evidence given the robust industrial demand in China, the price in New York is inherently limited in its downside potential. This effectively provides a protective put option for the market. The potential for loss is circumscribed by the arbitrage opportunity, while the upside remains theoretically unlimited due to the insolvency of paper short sellers. We are witnessing the balkanization of silver pricing. For a century, New York dictated the price and the global market followed. Now Shanghai has established a price floor and New York is struggling to maintain parity. The margin increase was a desperate gambit to reassert control, an attempt by the dominant powers to remind the market of their authority. However, the market, observing the $93 price in China, realized the empire's lack of substance. Paper-based instruments, such as margin adjustments, spoofing, and wash trading, are only effective when the physical market is dormant. However, the physical market is now acutely active, driven by substantial demand, and is effectively absorbing COMEX inventory. The 2.2 million ounces that departed the vaults today are permanently removed from the system. They will be melted down, repurposed for solar panel manufacturing, or shipped to entities like Samsung. They are irretrievably gone. Therefore, the system's response has failed on two distinct fronts. The financial weapon of margin adjustments proved incapable of crashing the price, and the physical asset base is rapidly diminishing. What remains? What is the establishment's next strategic move? If they are unable to arrest the price increase through margin adjustments and unable to secure adequate supply through policy interventions, they are left with only one recourse: to impede access. They must make it more difficult for the general public to participate in the market. We are already observing the initial manifestations of this strategy. In the concluding section of this in-depth analysis, we will examine the phenomenon of the retail lockout, discussing the new restrictions implemented by Costco, the sellout of products at the United States Mint, and the backwardation observed in futures contracts. The established system is attempting to cordon off the silver market, effectively excluding the public. Their objective is to secure the metal for their own strategic reserves. Failure to act promptly may result in being excluded from market participation. The Shanghai Shield has held firm. The current price stands at $83.89. Short sellers remain in an unfavorable financial position, and the vaults are 2 million ounces lighter than they were yesterday. The prevailing upward trend remains unbroken. We have arrived at our concluding observations. We have meticulously dissected the financial offensive initiated by the CME through margin hikes. We have exposed the geopolitical apprehension evidenced by the G7 meeting. We have analyzed the efficacy of the Shanghai Shield in preventing a price collapse. Now we must address the final element of this intricate situation, an element that directly impacts you. If the establishment cannot artificially depress the price through derivative market manipulations, and if they cannot secure sufficient supply from new mining operations, what is their ultimate recourse? Their final strategy is to close the access gates. They need to prevent the public from depleting the remaining inventory. We are already witnessing the initial, unambiguous indicators of retail rationing being implemented by major retailers across the United States. Consider Costco. For the past 2 years, Costco has served as a significant source of silver for the average American consumer, offering tubes of silver eagles and bars of gold with readily available stock. However, this situation has undergone a significant alteration today. We have received confirmed reports indicating that Costco has instituted stringent order limitations on physical silver transactions. They are now restricting sales to a single transaction per membership, with an absolute cap on the number of units that can be purchased. In a capitalist framework, why would a retailer impose limitations on the sale of a product that is experiencing exceptionally high demand and selling rapidly? If consumers wish to purchase, the natural inclination is to sell. One does not instruct them to cease purchasing. Such limitations are typically imposed when there is a dire concern about depleting inventory and an inability to replenish sold stock. Costco clearly recognizes that allowing unrestricted purchases at current price levels would result in the depletion of their entire national inventory within a matter of hours. This constitutes rationing. Albeit a less overt form, it is nonetheless rationing. Furthermore, observe the United States Mint, the governmental entity tasked with providing the populace with constitutional currency. They released the 2026 Silver Eagle coins this morning, and they have already sold out. The United States Mint has issued a notice of a full month's postponement on accepting new orders. Consider the implications. The United States government, despite its vast wealth and extensive reserves, is unable to mint a 1-ounce coin at a pace sufficient to satisfy consumer demand. This situation signifies a breakdown within the nation's sovereign supply infrastructure. It clearly indicates that the just-in-case, precautionary stockpiling has overwhelmed the federal government's production capabilities. However, the most significant and perhaps most revealing indicator of all is occurring within the futures market itself. This phenomenon is known as backwardation, and more specifically, backwards rolling. Typically, when a futures contract reaches its expiration date, market participants will shift their positions forward. They sell the contract that is expiring and simultaneously purchase the contract for the subsequent month. This is a standard operational procedure. But examining the figures from the CME Open Interest Report reveals something highly unusual. We are observing traders engaging in backward rolling. This means traders are actively striving to maintain their positions within the current delivery month. We observed 369 delivery notices being issued for January, yet the open interest only decreased by 233 contracts. This disparity demonstrates that for every individual exiting the market, another person is determined to secure a position within the immediate delivery window. They are actively acquiring January contracts because they lack confidence that the physical metal will be available in March. This situation precisely defines a market squeeze. Those who have sold short are in a precarious position. Those who have bought long are demanding physical delivery. The exchange, in an attempt to de-escalate the situation, is endeavoring to increase margin requirements to separate these parties. Therefore, what is the conclusion of this momentous day? The established system has faltered in its response. The CME deployed its ultimate weapon, a 15% increase in margin requirements, yet the price continues to trade near $84. The Treasury Department acknowledged its vulnerability during a meeting with the G7 nations. Retail vendors have commenced limiting sales. The entire system is signaling an emergency. They attempted to undermine market sentiment today. Their objective was for you to observe the margin increase and sell your holdings out of fear. They intended to create a negative price movement on trading charts to disrupt the existing trend, but the market did not falter. The defense established by Shanghai held firm. Physical commodity purchasers remained resolute. This price of $83.90 is not merely a number, it represents a declaration of victory. It signifies the precise moment the market recognized the bank's inability to counteract the scarcity of physical supply. So, what course of action should you consider? If you possess physical silver, do not allow them to intimidate you into selling. Do not permit a $2 price drop, precipitated by a rule alteration, to deter you from your established position. That tangible metal you hold is your sole safeguard against the escalating currency crisis, a situation the G7 nations are desperately trying to manage. If you are contemplating acquiring silver, understand that the opportunity is diminishing. Costco is rationing supplies. The mint is experiencing delays. Markups are escalating. The readily available silver has been depleted. We are now contending for the remaining quantities. The trajectory towards $100 is now unobstructed. The prior resistance level at $80 has been surpassed. The resistance encountered at $85 was tested and maintained. The next significant barrier will be the Shanghai price, standing at $93. We are poised to close that differential. It is a matter of inevitable physical realities. The established powers attempted to retaliate today, and their efforts were unsuccessful.